Hi, and welcome back to Tim Bigham's Options and Volatility newsletter. We'll be taking a look today at our latest trade idea, a bear call spread on IONQ, where a big rally is finally running into a little bit of a pushback. Implied volatility has exploded to the highest level, which means you can get more for the same distance out of the money, or get further out of the money and get the same net credit on an overbought and overloved IONQ. So let's jump in and take a look, shall we? So here's the actual trade. It's going out selling the traditional October 90.95 call spread for somewhere around 70 to 75 cents. Last I looked, still trading around 73 cents, even though the stock is now down on the day. Earlier, the stock was basically unchanged. That's when the kind of trade idea was generated, with the stock finally slowing down after a monster rally. Here you can see the chart, right, had been up 9 days in a row, believe it or not, had moved from basically 45 to 75 in the space of 2 trading weeks. So a monster rally, to say the least, a big time rally of 70 some percent in the stock. Finally getting a little pushback, which is the reason we came out with the trade idea today. Had been looking at it for several days, but always want to let the market tell you when maybe it's time to jump in and take a counter trend position. Today's price action kind of is hinting at that. We'll find out, because as we know, trading is all about probability, not certainty. Certainly the stock, the most overbought it's been this year, right? You can see 9-day RSI got over 90, is finally weakening, still overbought, but at least less overbought, right? MACD also got to by far the highest level this year before showing a little weakness too. Bollinger percent B well over 100, finally back under here. And just as importantly, if not the most, implied volatility now at the highest level basically since we saw the kind of big market sell-off back in mid-April after the Liberation Day lows were put in place. So IV, even with the stock moving higher, normally you see IV contract. IV actually expanded. Why? Because we saw a preponderance of call buying that drove up the IV across the board, but especially on the call side. We'll take a look in a second how the calls are now trading at a premium to similar out of the money puts. So here we can take a look at that kind of skew, right? That difference between out of the money calls and puts. I pulled this off actually yesterday when we were still looking at the stock and waiting for it to show some weakness. Stock was trading over 75. It was up $3. So the 20-point out of the money puts, right, we're trading at a 117 and change IV. The 20-point out of the money calls, right, the 95s, a 125 IV. Normally, almost invariably, you see that reversed. Out of the money puts trade at a higher IV than similar out of the money calls, because stocks tend to go up the escalator, it's called, down the elevator, right? They go up slowly, down quickly. Still the case here, but we've had such a big rally and such a big amount of call buying. And here you can see 14,000 of these well out of the money 100 calls trade. So everyone rushing in, right, to just simply position with the cheaper options for this to, continue to head higher. At some point, though, it gets out of hand, and I think we finally reached that point where we're getting some pushback by the market. And remember that 90.95 call spread with the stock trading, in the low 70s, you have, a nice upside cushion on this trade of certainly 15 to 20 more points. And we only have basically a little over 2 weeks for that to happen before the trade gets in trouble. That's the advantage of using implied volatility spikes. You can get further out of the money for a decent credit because of that IV spike. So that is one of the big reasons. Certainly we like that trade as well. You can see also here's that implied volatility. You can see what's happened over the past several weeks, right? IV now at the highest level really we have seen since, again, earnings and then the Liberation Day lows, right? You can see yesterday IV spiked once again across the entire IV surface, right? And you can see here, this is very interesting. Current IV percentile over 50%. That's with the VIX nearer the lows, right, of the past year, but with IONQ, because of all that big, especially call buying, it pushed the implied volatility up towards past the average, right? And you can see here where implied volatility at the money is a general kind of look, was trading kind of around that 70-ish level for the longest time. Then we just saw this ramp up to this level here where it's well over 100. You can see the puts with a similar sort of profile versus the calls here, right? But you can see now the calls, right, trading at a premium IV to the puts. Here's that difference. You can see it was pretty much flat, but lately we've seen the calls, because of all the preponderance of speculative call buying, trading at a much higher level than the puts. That's almost invariably a sign that the speculation has gotten a little frothy and it might be time for at least the rally to slow down. We can also take a look at it here on a specific one on the 30-day, right? 30 delta and 25 delta call, 30 delta put, 25 delta call, right? You can see how the implied volatility on both is very much tied together, right, because of put call parity. And you can see how the big volume that came in drove this IV to extremes. And you also see how recently, right, the call IV has shot well past the put IV, right? So we're seeing this huge, huge premium. The call skew now favoring the calls in a big way, which we like to take advantage of that as well by selling, especially those expensive calls in the form of a call spread, right? And we're able to get a bigger net credit than certainly back here for the same kind of cushion. So that's really the reason we took a position finally in IONQ. Had been up 9 days in a row, finally saw at least a little pushback this morning, came out with that trade idea, sell the 90-95 call spread for around 70 to 75 cents. Nice risk return of about 17%. We have that, roughly 20-ish point upside cushion on the trade. The stock can continue to go up, but we have 20 points till it really kind of gets problematic, right? Why? Because this massive jump in IV, and invariably we'll probably see that reversion, which will be a benefit for our trade structure as well. And as we saw, the stock certainly deeply overbought as far as on the technicals here. Fundamentals, there are no really fundamentals because the stock has yet to make money here. So we'll see how the trade turns out, because once again, trading is all about probabilities, not certainty, but trying to continue to put the odds in your favor from a technical perspective, right? And from that IV perspective, right? At least gives you a very good fighting chance. So until next time, as always, here's the good trading. Take